Good morning. Welcome to Trading Hour. I'm Reema Tendulkar with Mia Pavitra Parekh and Surbhi Upadhyay, and things are looking good for our markets. Third consecutive day of buying. The Nifty is above 18,100, 18,120. It's a triple-digit gain on the Sensex. We're up 370 points. That said, we have slipped a tad bit from the top of the trading session. The high today was about 15 odd points above, but as you can see, things are looking up. Asian markets are strong. The Hang Seng is a gain of 2.2%. The Korean markets are up 1.8%. Straits Times up 1.25%. The leadership is firmly with the IT space. The Nifty IT index is a gain of close to about 1.5%. Tech Mahindra has been leading the charge there for the second consecutive day. And if you look at the gainers list, it pretty much looks like yesterday's gainers, right? You've got ONGC there, Apollo Hospitals. These were the stocks which were higher in trade yesterday, and they're up today as well. In the broader markets, you can see some weakness in Nykaa. Nykaa has lost 10% this week. So after it came out with their numbers, Nykaa has been struggling a bit. And Tejas Networks, the stock that we were talking about yesterday in closing bell, Tejas Networks is firing yet again. But Surbhi, this is looking good, right? Markets, whenever you break out after a very long period of consolidation, and especially in the last couple of days, we were trading in a very tight band. Yeah. When you break out after a very tight consolidation, and consolidation over a longer period of time, it is a positive and encouraging sign.
Oh, absolutely. And I think even more important than breaking out is staying there, right? Because otherwise we have all of these mini false breakouts and then you go back into the lull. But what today is telling us that this is looking good. This is looking like it's something real. Now, whether we can build on it is the bigger question, or whether it just kind of stays here with this 100-point up move or not. But you know, there is evidence that this is perhaps trying to get a little broader as well. And why do I say that? Because look at the mid-cap index. This is no longer a very narrow market move with 5 or 6 major Nifty stocks leading it. No, this is much bigger. The banks are participating. Most of your large cap Nifty names are doing pretty well. On the flip side, I mean, you don't have too many major cuts. You have maybe a BPCL or a Hero Moto which are down, but the other stocks which are technically in the red are in the red because they're down by a couple of rupees here and there. No major declines on the other side. That's the second point. Mid caps are participating. That's the other sort of important aspect to keep in mind. Look at the advanced decline ratio. It's very healthy right now. Over 1,800 advancing stocks and about 900, less than 9 declining stocks. And last but not the least, when you see sectors like healthcare moving, which is the status quo today, look at Apollo Hospitals, Sun Pharma, a couple of other names like Divi's. Now, healthcare as a sector is something that hasn't moved. The market has moved over its fixation with healthcare after COVID. But when you see buying return even to those pockets, then you know that perhaps momentum is beginning to build up, and at least traders or even maybe short-term investors are alive and kicking. The screen looks pretty interesting, to say the least. Pavitra?
Oh, absolutely, it does. And, like you were pointing out, we have finally broken out of that range. We also have to talk about all of the Adani group of stocks today, of course, after the MSCI did defer the earlier decision. So everything barring the Total Gas stock is in the green. So that, keep your eye out on that entire pack. Tech, like we were pointing, of course, Tech Mahindra has done very well, but the rest of the stocks also holding up with good gains coming through. On the downside, no big cuts, but of course, there's a little bit of red seen in the FMCG stocks. Remember, Nestle will be posting results in perhaps the next hour or so. So do watch out for that entire pack. For now, Nestle, HE World, Britannia are the ones where you're seeing a little bit of weakness come through, and some of the insurance names. But in terms of cues, you do have the US Producer Price Index numbers that will come out today. That will be important to watch. It is the weekly FNO expiry, so that is something that we're tracking as well. And, we could expect some volatility on account of that towards the end of the trading session. But that's what's going on for the markets. Let's actually kickstart the show now by focusing on the markets and getting a conversation going. We have Rohit Srivastava, founder and strategist at IndiaCharts.com, joining us now to take some questions. Rohit, thanks a lot for joining us. This is Pavitra. Like we were just talking about, we seem to have broken out of that tight range that we were consolidating in for so long. Your thoughts on this, and do you think that we can now sustain at these levels?
Yes, Pavitra, I think the worst is over. A lot of people have been probably waiting to hear that. But if we just look back a little bit, the biggest volatility that we saw was on this year's budget day. We made a low of 18,353. We made a high of 17,353 and a high of 17,972. And yesterday we've actually closed above the budget day high. So this is getting over all the negative sentiment that had built, around the entire Adani fiasco that we've seen. And I think the markets meaningfully discounted it. And it's history, whatever may come out of this issue, history is that, whenever an event comes across which plays on the minds of everybody to the extent where you start questioning even the India story, historically that has been at the end of bear markets. Now, the only difference this time is that maybe the market's not down 30% or something like that. But in terms of sentiment, it will look like this was the last shoe to drop, the last bad news for the markets. It's been absorbed. And that means we have a very clean and clear way forward now from here for the rest of 2024. So that's the good news.
Rohit, the previous swing high levels of 18,200, 18,250, do they act as formidable resistance levels for the index to move higher from here on? And what about the Nifty Bank?
So the Nifty Bank did not close above, say, 42,015, which was the budget day high. It has not yet done that. So that maybe we can even say, okay, we want that additional confirmation as well from the banking side. We do see positive momentum in some of the bank stocks. So I think it will eventually happen. But when it comes to resistances, yes, these are key levels where probably the market will pause, maybe for a day, maybe for two. But I don't think they will be levels which will hold you back for very long. I mean, apart from acting like a short-term resistance, eventually I think we are headed higher. That's what the bigger setup really is, which I'm trying to point out to that. We've discounted the worst. We've seen all the bad events. There's nothing new bad that can really, come out from here, at least for the next 6 months. Even if you look at global cues, for example, the risk has been rising interest rates. So increasingly, the markets are trying to price in that at least rate hikes will slow down because inflation data is going to continue to cool into June and into September of next year. So as that happens, and there are, of course, divergent moves that different central banks are taking around the world, which is keeping net global liquidity on the rise, which is probably why global equity markets have already moved up ahead of India. India was just facing its own issue, but now we should join the rest of the world in that direction. So that's the overall call.
That would be music to the bulls' ears, Rohit, if that indeed starts playing out. So tell us, what will take the market higher? I mean, so far this year, it's only been technology, though we've not done as well as the NASDAQ, but relatively speaking, I mean, tech has been the hot space. What else will join the party?
So apart from tech, I think metals should do so. We've seen the dollar index really fall back below 104. Why 104 was important is that we'd made a double top between 2017 and 2020. And as long as the DXY was below that, it was really stimulating the return of the commodity cycle. The spike above that created a lot of fear. Now we've gone below that. We've seen a recent bounce in the short term last 2-3 days. Again, we are seeing resistance close to that level. So I think as long as we stay down there, it sparks the commodity cycle all over again. Now, most of the prices, for example, copper, aluminium, have bounced back from the lows. And what we'll watch out for is that rally resume. So I think if you just look at the short-term setup of the Nifty Metal Index, the bounce that we saw from the December low has retraced exactly 61% in the last 2-3 days. And so, and we can see that in individual stock names as well. Like I was watching Steel Authority, National Aluminium, all of them are at 61% retracement of the recent rally. So this is a very good level from where I would expect the metal space overall to resume its upward trend. So I think IT and metals, the worst performers of last year, are turning around to be one of the better performers for the year. But it won't be only around that. We spoke of banking. I think banking stocks should also do well. Particular large caps have seen a rebound. I think Reliance has been one of the bigger underperformers of the last 2 years. We haven't seen it do much apart from move up and down in this 2,200, 3,000 kind of 2,800 range for very long. I think a large part of that may be done because the monthly volatility is really contracted to the lowest level that we have seen in the past, which means usually you get a directional move from here. Then you need to bet on which side that direction will really be. So I sense that there is a case for some of these large caps like Reliance, Bajaj Finance, etc., to really join the rally. And so that should also kick in. Any other sectors, I think apart from, oil, I think capital goods, which is continued to get support from the budget last year and this year. So the capex cycle continues to, move ahead. Capital goods sector should do well. So these are, I think, four broad sectors which I think will help the rally. I do see a pause short term in PSU stocks in general, which had done well, I think, in the last quarter of last year, even when the markets were dull. I think they will do well on a 1 year, 2 year basis because of the underlying value and the turnaround maybe in economic activity. But shorter term, PSU stocks, because they've done so well, and usually after the budget and there's too much betting on them during budget time, it can lead to a slightly longer consolidation, but eventually they should pick up too.
All right, got it. So you like banks, you like IT, you like some of the capital good names as well, and metals, which you've, of course, been bullish on for a very long time. Rohit, is there something that you're absolutely avoiding right now and you think just does not make for a good investment at this point?
So I think new age stocks, that was an attractive sector, all of which got listed last year. They are still looking like avoidable. Maybe they pick up with the market, but I'm not so sure. We don't have very clear setups in that entire group. If we put them together, as one group or one index, probably take time to see momentum come back there. So I think that is one segment that we can actually think of being away from.
Okay. Any thoughts on what we've seen in the pharmaceutical stocks? Many of them have reported weak numbers. We've seen the stock prices under pressure, whether it's Divi's, Lupin, Supriya, for instance. That's one of the recent listings, and that's been reporting weak numbers. What are the charts telling you on any of these pharmaceutical names? Any stock which stands out?
So over the last few months, we've been trying to push the idea that maybe in a weak market, pharma is a good place to be in. They haven't done well, but I sense they are bottoming out. But here's the flip side that when markets pick up, if they do what I'm saying, which is you start a good broad-based market rally, the pharma sector also tends to move up less than the rest because the money ends up chasing growth and other things versus defense, which is probably why it is possible that they'll move up more slowly than the rest of the market. But I do sense that the worst is over. We've seen, I think, post-pandemic, the rally that we saw during the pandemic, the pharma rally ended up peaking out very, very early in 2021. So it's actually been through a very prolonged corrective or dull phase, except for a few outperformers, I think, like Sun Pharma, which held out better than the others. Most of them went through a deep correction. We've seen that in Dr. Reddy, Cipla, all the big names which are in the index. And so like I was saying, the pharma index may have done its worst, but they may be slow to pick up. That's my sense.
All right, got that, Rohit. Thank you very much for stopping by today and giving us some perspective. And of course, are you expecting the markets to go higher from here? I think a lot of people, the bulls especially, will really love the sound of that. Let's take a quick break on that note. We'll come back and put the spotlight on a lot of buzzing stocks that are active in today's action. Welcome back. We've been telling you about the market, which is in fine form today. Let's focus on a couple of individual stocks which are catching the headlines. And Interglobe Aviation is one of them. The stock has been down about 4.5%. This after a large block deal happened. We believe, of course, the confirmation only comes in aftermarket hours. We believe that a part of the Gangwal family has sold out in today's block. Vivek, do fill us in on some more details.
Well, absolutely right. As you mentioned, we'll get a confirmation, once the exchanges upload the bulk and block deal information. But however, what we know for certain is that 4.4% of the total equity changed hands via the block deal. And what we understand from our sources is that, and we actually had access to the term sheet as well, is that Shobha Gangwal was the likely seller in today's block deal. A 4% stake is what we were anticipating is what she would be paring from her existing 7% stake. So now, the interesting part is there is a further a lockup period of 150 days after this particular block deal. So for the next 5 months, don't anticipate another block deal as far as Indigo is concerned, as per the term sheet. Now, this is in line with what Rakesh Gangwal had intimated the exchanges on February 2022. He stepped down from the company board, and he also said very clearly that over a 5-year period, he would be trimming his holdings. At the end of the December quarter, Shobha Gangwal, Rakesh Gangwal and the family trust held a little over 33.78% stake, which now drops to around 29% post today's block deal.
Okay, thank you very much for that. I'm looking at Vodafone Idea. Now, yesterday was the conference call between 2:30 and 3:30 p.m. The big takeaway was that for the first time, the management has quantified the payout that the company has to do to the government once the moratorium ends. Remember, Vodafone Idea has opted for a 4-year moratorium on their spectrum payouts and on the AGR payouts. The spectrum payout moratorium ends in October 2025 and the AGR payout ends in March 2026, which basically means in the next 3.5 years, the company has hefty payouts due. They begin in October 2025, and the amount that the company is saying is 41,300 crore rupees. Now, this is a big amount. To put it in context, 41,900 crore rupees was the annual revenue of Vodafone Idea if I take the last 4 quarters into account. If I look at the EBITDA over the last 4 quarters, we're talking about an EBITDA of 17,500. So 41,300 crore is a big amount considering the financials of Vodafone Idea. IIFL, the brokerage, says that unless Vodafone Idea manages to double its revenues in the next 3 years, which is when the payouts begin, making these payments is going to be difficult. So that is the key takeaway. There were a lot of other takeaways, like the analyst questioned on pricing, but they indicated that it's a bit of a wait and watch approach. They're going to watch what competition is doing and then take a call. But the big headline takeaway is, for the first time, the company has quantified the payouts that the company has to do beginning October 2025 once all the moratoriums come to an end, and it's a large amount of 41,300 crore rupees. IIFL says we're past the first hurdle in a long obstacle course. They have a reduced rating on the stock. Nomura brings down the target price to 5 rupees versus 8 rupees. They're saying the company's reluctance to raise the prices of entry-level products and plans also points to the lack of confidence in retaining their subscriber. CLSA also a sell call, and the target price has been brought down to 5 rupees. So that's about Vodafone Idea. The stock is a bit subdued. But we'll slip into a very short break. As we do that, we'll get you some important market opinion from Sailesh Rajbhan of Nippon India Mutual Fund.
IT space has, the fear of a very sharp decline in terms of demand. I think to that degree has not yet come about. But you must understand that these are a little early cycles in terms of, how the demand conditions will be behaving, especially when US has continued to remain fairly strong. As weakness in US because of higher interest rates feeds in, we just need to understand how companies and corporates behave at that point of time. So maybe you'll have clarity maybe in the next 3-4 months in terms of how demand conditions in the US are behaving, and hence whether the earning growth outlook for these businesses is late single digit or double digit will be visible maybe very clearly in the next 3-4-5 months, because that will really decide on how the opportunity to execute comes about. Consumer durables are in some sense facing a perfect storm, after the rebound of COVID and all, and significant preponement in demand. You've got and now with higher inflation and prices hitting the income levels and hitting the kind of consumer sentiment, you've seen a slowdown there. Clearly, these are some of the most underpenetrated categories in India and have a very, very meaningful runway. And like you rightly said, these corrections have made valuations very, very normal now. They are no longer those 40 times, 45 times, 50 times earnings on very strong earning expectations. There would now be 25, 30 times on very modest earning expectations. So the risk reward is certainly becoming very interesting in this space.
Hey guys, welcome back. You're still tuned into Trading Hour here on CNBC-TV18. For the market, it is a 100-point gain that we're looking at right now. The Nifty bank has come off a little bit from the levels that we started, but it's still holding up around 0.3% higher. The stocks which have slipped a bit include SBI. You have Axis Bank, which has come down a little bit. So, keep those on your radar. But overall, it's still around a 130-point gain that we are seeing there. But let's now talk about the Adani group of stocks. The MSCI has deferred changes announced in the weightage of Adani Total Gas as well as Adani Transmission to its May review. So Vivek is here to fill us in with all of the details on this. Vivek?
Well, that's right. So it's a surprise announcement that came in from the MSCI today morning where they said that, as you mentioned, they've deferred the treatment or the weight reduction of a couple of stocks from the Adani pack within the MSCI standard index. So first on our list is Adani Total Gas and Adani Transmission. So MSCI was expected to reduce the weightage of the stocks, and the estimated impact as per analysts was $125 million and $165 million respectively. However, what MSCI said is that on the back of potential replicability issues due to impact of price limit mechanisms, in this particular index review, they will not be doing it, and it's been pushed to the May review. Basically, what it means is that because all of these stocks were trading at the lower circuit limit for multiple trading sessions, it wouldn't have been possible for funds that track the MSCI closely to go ahead and implement the changes within their own funds. On the back of that, this particular deferment has been made. When you're talking about Adani Enterprises, the estimated impact, which was a little over $180 million, will now be slightly reduced. However, it is expected that the weight reduction expected in Adani Enterprises will continue. Further, what MSCI said is that there will now be a special treatment of all of the Adani Group stocks within the MSCI index until the next index review. It's important to note that all of the Adani Group stocks, barring recent listing Adani Wilmar and NDTV, are part of the MSCI standard indices.
Okay, got that. Thanks very much, Vivek, for bringing us up to speed with everything that's happening with Adani, specifically those MSCI index changes or potential changes that have been now pushed back, really. With that, let's shift focus and look at Tanla Platforms. If you look at the stock right now, it's up almost, 9%. Rima, help us understand this. So it seems that they're developing or are going to develop a platform that helps you get away from phone phishing. You have my attention by just mentioning that.
Okay, so they're planning to launch a platform called Wisely ATP. ATP stands for Anti-Phishing Technology Platforms, hence the name ATP. The patent is yet to be granted on that. But, for those who don't know, phishing is basically where you try and conduct some cyber scams. You pretend to be someone, you will get an SMS from someone that you think you know, it's a trusted person, and they will ask you to click on a particular link and make some payments, but it turns out to be a fraud. And a lot of people have been losing money on the back of this phishing, whether it's on SMS, whether it's on emails, and this is a global and a growing problem across the board. So Tanla Platforms is saying that we're going to be launching an anti-phishing technology platforms. The launch will take place at the Mobile World Congress, so they will unveil it on the 27th of February. Now the company has, as I said, the product is yet, the patent is still pending for it, but what the company has done is that under the umbrage of TRAI, the Telecom Regulatory Authority of India, they have set up a regulatory sandbox. Regulatory sandbox means this product, this platform is being tested. Live testing is going on, but under a regulated environment. So that's what a regulatory sandbox means, that they are testing the products live, but in a regulated environment before they can go public with it. The validation of the impact is still in process. Parallelly, the company is also in advanced discussion with 3 major banks in India to launch a proof of concept. So the street is clearly excited about the prospects and what this could mean for Tanla Platforms. Remember, Tanla Platforms already has a lot of banks as their clients, because this is, it helps in the completion of your any kind of transaction that you do. They help with the OTP that gets vetted through Tanla Platforms. So they have linkages with many banks. So this could be an additional product that they could look to sell to their existing clients. So the stock is up 8.5%, but it's been going through a rough time in terms of financials, as a result of which the stock is down more than 60% in the last 1 year. So on a low base, it's also seen a bit of a rebound.
Okay, that's Tanla Platforms. Very interesting story coming in over there with their anti-phishing solutions. Well, with that, let's go across to Rahul Mohinder and try and fish out some interesting picks in this market. Rahul, thanks for joining in. A good move today after a while, right? I mean, we've got so used to seeing such a narrow, flattish market, very tight range. So this is a welcome change, I guess. But you tell us, how are you reading what we've seen on the index over the last day or two? And, of course, stocks on your radar.
Morning, I think much awaited and much expected. In fact, last week when I was on the show, we were around that 17,800 level, and I mentioned that, I may be early on it, but I clearly see 18,100 coming, where I even talked about buying stocks like Reliance, etc. So I think really technically this is more on expected lines, and I think the follow through will continue. We would elevate to much higher levels, particularly if we can go past a level of 18,150. I think we definitely trot a good 200-300 points further. So what is my advice to someone who's already in the Nifty or probably contemplating a buy? If you're looking at the very short term or just maybe even intraday, I think look at 17,950 as a key support, and if you're just looking at an intraday level, I'd say that 18,070, that's a good support for the day. I think these are two levels I'd keep in mind, both from a short term and medium term perspective. But again, I still feel the trajectory is up, and that's clearly because when I look at the heavyweights, banking still has a lot to catch up. We are all seeing it still a bit soft. My own sense is, like I mentioned earlier also in my previous interviews, we need to get past 42,000 odd on the Nifty Bank to get a lot more clarity. But having said that, one sees internal signs that there could be a possible catch-up. Stocks like Kotak Bank, Axis Bank, they all look interesting. That brings me to some of the buy calls. Axis Bank, could be clearly bought into 850. Could be a stop loss if you're trying to build a position. I clearly think that the stock is headed much higher. But if you're a day trader or someone trading the near term, I think move for 883 as a target. Keep a stop loss at 860. That's if you're an intraday trader. If you can give it 850 as a stop loss as a position trader, I think the stock will deliver a lot more. So my sense is try and hold on to this, not just as a day trade. The second buy would be Infosys. I was eyeing Tech Mahindra. The stock's already run up a lot. And amongst the tech space, Infi is another stock which could move up. 1650 is my target on Infosys. I'd keep a stop loss of 1580 and go long on it even at current levels. And finally, I think auto could do a good catch up. So Maruti would be my pick here. I think keep a stop loss at 87.50. We should go past or at least to the previous high of 9030. So I think we're getting to that 9,000 mark on Maruti, and I think we should trot up. So on the whole, I'm all buys.
Okay, thank you very much for that. We look forward to chatting with you through the course of the day. Get into a break. India's goods trade deficit has fallen sharply in the month of January to a 16-month low. Complete details lined up on the other side. Welcome back. Markets holding on to all their gains. It's 18,100 plus on the Nifty, 90 points higher. On the Sensex, we're up 370 points. Mid-caps moving in step with the frontliners. And today, we've got a positive advanced decline ratio. For the last couple of days, the advanced decline ratio has been a bit iffy. But today, we've got nearly 2 stocks in the green for 1 in the red. But let's talk about India's macros. India's goods trade deficit has fallen very sharply in the month of January. It now stands at a 16-month low. The fall is a relief for the rupee, and this is on account of a steep fall in imports. Lata joins in with the key numbers. Lata.
Well, I think the January trade deficit has many positives for the macros of the economy. The first one is what you mentioned, that trade deficit coming in a good, 16% lower than December. But it's not just that it is a 16-month low. The point is, even if you took the April-December average monthly deficit, it was actually 25.5 billion. So look at 17.6. It's a good 30% less than what we were ticking in the last 9 months. And the deficit, the reason is that it is largely because of a fall in imports. January imports was just about 50 billion. December was 58.2 billion or thereabouts. so January imports are also lowest in 16 months. And if you compare them to the average April-December monthly, they are again a good 17% less. We were ticking 60 billion every month. Now in January, it's only 50 billion in imports. And the key imports that have fallen, this is very important, it's gold and precious stones. And there's also a goodish bit of fall in electronics and chemicals and metals. I would assume chemicals and metals is also because prices have fallen. The other positive, and maybe the icing on the cake, is that services plus goods, if you take the composite trade deficit, it's down to just $1 billion. 1.2 billion to be precise. And this is quite an outlier number, because if you look at the April-December average, the monthly deficit goods plus services was actually 12 billion. So we have really, January has been a month of many splendors and positives. Very good for those of us who are tracking current account deficit and the rupee depreciation. This is certainly a strength. Just a little bit on the negatives, exports have also fallen. Exports have come in at 32.9 billion in January. That is, a good 8% lower than what it was in December. 34.5 billion. It's also lower than the average that we were doing for the last 9 months. Key exports that have fallen are textiles, engineering goods, gems and jewelry, all labor-intensive goods. So we should be unhappy about that as well.
Okay, got that. Thanks very much for the perspective, Lata. We will take a quick break on that note. On the other side, we'll put the spotlight on some of the measures that were announced in the budget for the GIFT City, IFSC, and whether they'll really lead to a big boost in terms of business at GIFT. We'll be chatting with Vivek Iyer of Grant Thornton, Bharat. Welcome back. Now, the budget this year provided an impetus to the Gujarat International Finance City, the GIFT City as it's known. Now, the powers under the SEZ Act will be delegated to the IFSCA, which is the International Financial Services Centre Authority, to avoid dual regulation. Also, approval from SEZ authorities, GST and RBI, SEBI, IRDAI, all of these approvals will come under a single IT window. So these are some of the changes that perhaps are going to usher in better times for all those operating out of GIFT City. Vivek Iyer is partner and he's risk leader of financial services at Grant Thornton, Bharat, and he's joining in to discuss the implications of what was announced in the budget. Vivek, thanks very much for being here with us. We've had a chance to go over the fine print over the last couple of weeks. So you tell us, let's start with the framework itself, the points that I mentioned, that you have the single window clearance coming in and, powers being granted to the IFSC authority. How significant would this be in terms of the architectural framework for GIFT City?
So the architectural framework for GIFT City will become significantly simple. The objective would be that all the market participants do not have to go to multiple regulators. They just have to go, just imagine getting into one web page and kind of knowing what all your requirements are and just kind of finishing and updating all of them for the purpose of getting all clearances. Ease of doing business is it cannot be better described than this initiative that's actually being driven. Offering a single window IT system for IFSC, SEZ, GST and RBI, SEBI, IRDA is one of the ways in which all the requirements actually come in one window. They significantly ease the whole process of setting up a business within GIFT City. So from an architectural, structure standpoint, personally, in terms of, I think it's a great way of, honestly, in terms of really crediting the way the framework eases up.
Do stay on. We're getting numbers coming in from Nestle. Appears to be bang in line with what the street was anticipating. At the bottom line, the company has done a profit of 628. This compares with our poll of 618, so in line, and it implies a growth of about 62% on the bottom line. Margins have come in ahead of street expectations, so beating our poll by 150 basis points. EBITDA margins at 22.9%, which means unchanged compared to what the levels were a year ago. The street was anticipating some margin contraction that's not taken place, and the margins have come in better than street and what the street was anticipating. So So 22.9%. There you have it. The beat for Nestle is in the margin performance ahead of what the street was anticipating. The reason the profit is showing such a big jump of 62% on a year-on-year basis, that's because there was an exceptional loss of 236 crore in the comparable quarter of last year. If you strip that out, the number is not going to, the profit growth is not going to be that large. Top line broadly in line with street estimates, perhaps missing our poll by about 120 odd crore, but on the margins, the company has delivered a beat and the street seems to be liking it, though the stock has come off a tad bit from the top of the trading session, but holding up in the green. This is also one of the more expensive stocks, right? Trading at about 60 times forward multiple.
Okay, well, that's the Nestle number, but let's get back to that conversation with Vivek. Vivek, let's get in your thoughts on what it will mean to allow ODIs, or these offshore derivative instruments, from GIFT City. I remember a couple of years back, SEBI had come down quite heavy on these instruments, ODIs. They were seen as very opaque. They were seen as not prescribing to the law of the land. So what marks the change now to sort of make them, to institutionalize them from GIFT City? And what kind of derivative products do you think will be offered? Will there be more will there be more takers?
So definitely in terms of the whole ODI piece is a great initiative, because the whole challenge of the ODI process earlier was about lack of visibility on who the ultimate investors were. And the whole challenge was that it was in an entirely different jurisdiction. The challenge was absence of control. Now with GIFT City, it actually offers us a gateway into the international market, and it now allows us the facility to actually get overseas investors to actually use the GIFT City route, use the ODI route for the purpose of actually offering Indian investments for the purpose of these investors through the ODI route. The ODI was never a challenge. The whole point was the underlying visibility that they actually had on the ultimate end investors, with which GIFT City, the whole problem stands addressed, and it is only natural that from an ODI perspective, it was but a natural step to kind of bring that in. And this is just the starting point, because once we have ODI kind of instruments kind of being active, we will have a lot more capital coming in, a lot more investments coming in, and a lot more derivative products actually being offered. Because more the amount of investments, more the capital, more would be the need to actually hedge your positions, which offers need for different kinds of instruments to happen. I mean, just an example, maybe I'm extending it here, but deepening the fixed income market in India, having actually a high yield bond market in India could actually be a next step. Having derivatives in relation to that could be a next step. So maybe I'm getting ahead of myself, but these are really interesting times, and in terms of even sky is not the limit in terms of what are the kind of products that can be offered.
I was just getting to that. Given what you understand, talking to a lot of the players involved, what sort of derivative products will fly off the shelf first? I mean, I don't know if they look at derivatives with equities being the underlying, or are we talking forex? You mentioned bonds. What do you hear?
So in terms of, definitely in terms of a lot of derivatives on the FX side, because that's the first natural step that you will in terms of take from that standpoint. Also in terms of, given the whole inflation issues globally, interest rates are going to play a key role. And as a result of that, from an underlying fixed income standpoint, we would see a lot of fixed income derivatives as well. Equity derivatives are there. There is always an allocation to equities that will be there as a part of the portfolio. But a lot of fixed income derivatives, a lot of currency derivatives are some of the products that we can actually, in terms of expect. Currency futures, exchange traded derivatives will be big. In terms of, given the fact that we have really strong depth on the from an exchange perspective within GIFT City, we see actually exchange traded derivatives picking up in a big manner. And we will see a lot of innovation in that space.
Okay, there's also this talk of, I think, building some sort of, data centers for these foreign firms that want to operate out of GIFT, where they can have better cloud storage systems. I mean, it sounds like a very operational thing. When you read something like that in the budget speech, you don't really pay much attention. But is it that important? Can it be a game changer and actually bring more banks, bring more entities to set up shop in GIFT City?
It is phenomenal. And to be very honest, I know that, in fact, I believe that a lot of attention wasn't given to the whole data embassy story. I mean, let me just draw a parallel. The whole point of actually having an embassy in different countries is for the purpose of managing diplomatic relationships. And given the whole foreign policy. Now, imagine data is extremely important today, and every country is very sensitive about its data as much as it's about sovereignty. allowing each one of these countries to have embassies, which will enable them to protect their data, to look in terms of how critically and crucially and secure the data is maintained within a gift city environment, will be simply brilliant, because it basically ensures data security, gives each one of the countries the comfort that their data is being handled effectively, and also gives them oversight over the data that is stored, even though geographically within India, it's actually within the IFSC authority. So data embassies, I believe, is a great step in terms of offering that comfort, which from a data perspective is extremely important today, because we have heard data is the new oil, and that's a conversation that consistently happens. But in terms of the whole process that's actually been put around, this is something that's extremely brilliant in terms of the way it's come out.
Okay, all right. Sounds quite interesting. Vivek, we've run out of time, but thanks very much for highlighting some of these nuances that came out as a key positive for Gift City IFSC. Thanks very much for joining in on this. All right, with that, let's shift focus back to the market and that Nestle stock reaction, which is very interesting. Stocks back up about 1.5%. Mangalam's here. Mangalam, what's the read-through?
Well, these are good numbers from Nestle, especially on the operational front, and which is why the stock has moved higher as well. Most on the street were expecting a double-digit mid-teens sort of growth, and that's primarily because Nestle is relatively less impacted by the slowdown that we're seeing in rural, because most of the Nestle sales come in from urban itself, and in rural also, which is about 20-25% of their sales, they are increasing their distribution. So that alone would cause their revenue to grow. So that's a positive. Secondly, the worry was that because of the high inflation that we're seeing in dairy, because of lumpy skin disease, etc., that could impact their margins. Yes, it has impacted their gross margins by about 200 basis points, but that hasn't impacted their EBITDA by as much. So, the company has been smart in passing on prices, at the same time, maintaining their margins and optimizing their costs. As a result of which, the margins have come in at 23%, as against street expectations of 21.5%, and which is what has led to a mild beat that we're seeing in the net profit. The domestic business for the company grew at around 13.8%. The exports, which is about 3 to 4% of their overall sales, has also grown at 17%. And going forward, the big trigger for Nestle will be the increased sales coming in from their pet care vertical Purina and the Gerber, cereal baby food products that they have launched in India, which would be high realizations as well. My sense is that maybe to protect their margins, the company has taken higher price hikes, which is why the revenue at 15% growth is slightly lower than street expectations of 17%, but they more than made up for it by improving their margins, as a result of which the stock is higher as we speak.
Mangalam, thank you very much for that. Naveen Kulkarni, CIO at Axis Securities PMS, is now with us on the show. Naveen, would you concur that perhaps the company has taken more price hikes, which is why the volume growth may be a little subdued and there is a bit of a revenue miss, but the margin performance looks absolutely fabulous? Thoughts on the numbers?
Yeah, that's a possibility, because EBITDA has beaten our expectations by close to around 7 to 8%, right? So that's a significant beat on our expectations. So we were actually expecting the EBITDA margins to be lower than what the company has reported. So it could be on account of probably the mix being more skewed towards pricing than towards volume, because that has a significant impact on the EBITDA numbers. Overall, nonetheless, I would say that these are pretty good numbers. Nestle has been doing quite well. In fact, Q2 numbers also surprised us positively, and Q3 also has surprised us positively. So that's almost 2 quarters that the company has managed to beat our expectations. So overall, I would say that a pretty good operating performance from Nestle.
Okay, pretty good operating performance, and the street also seems to like that. The stock is up 1.3% as we speak. Naveen, very quickly, what is your rating on the stock? And if you could take us through the target price on this one as well.
So we will review the target price after having a look at the numbers in detail. So right now I'll not be able to comment on the target price, but post working out the numbers, we'll be able to figure out what could be the target price. But overall, it looks to be quite positive to me, and I think Nestle can still deliver 12 to 13% returns in the next 1 year.
Okay, can deliver 12 to 13% returns. We are also waiting by for the management commentary, to understand what they think of demand, what the inflation picture is really looking like for them. And I guess it'll be important to watch how the pet care business has done as well. That was one of the, that's something that we're going to track as well from the management. But with that, we are going to wind down on this edition of Trading Hour. You stay tuned. A halftime report comes up next, and they're going to take all of this action forward.
Brought to you by Q